Options are where the market starts to get strategic. They're not about ownership, they're about rights and obligations. And understanding those two words, right and obligation, is how you master this chapter. Let's start with the basics. An option is a contract between two parties, a buyer and a seller. The buyer pays a premium for the right, but not the obligation, to buy or sell an underlying security at a set price, known as the strike price, on or before a set date, known as the expiration date. There are two types of options, calls and puts. A call option gives the buyer the right to buy the underlying security at the strike price. A put option gives the buyer the right to sell the underlying security at the strike price. Every option represents 100 shares of the underlying stock, unless otherwise stated. Let's break down the positions. If you buy a call, you have the right to buy. You're bullish. If you sell a call, you have the obligation to sell. You're bearish. If you buy a put, you have the right to sell. You're bearish. If you sell a put, you have the obligation to buy. You're bullish. It's that simple pattern that frames everything else in options trading. Now, every options question, whether it's on the exam or in real life, ultimately comes down to profit, loss, and break even. So let's anchor those. For a long call, your break even equals the strike price plus the premium. For a long put, your break even equals the strike price minus the premium. A call buyer wants the market to rise above that break even. A put buyer wants the market to fall below it. And for the seller or writer, it's just the opposite. Piano slides in under the explanation, steady and confident. Let's try a few examples in your mind. If you buy a 50 call for 3, your break even is 53. Above 53, you profit. Below 53, you lose your $300 premium. If you buy a 60 put for 4, your break even is 56. Below 56, you profit. Above 56, you lose the $400 premium. Maximum gain for any option buyer is unlimited for calls, because there's no cap on how high a stock can go. For puts, the maximum gain is limited, because a stock can only fall to 0. Maximum loss for any buyer is always the premium paid. For the seller, it's flipped. The maximum gain for a call or put writer is the premium received, and the potential loss can be substantial, even unlimited for uncovered call writers. That's why suitability and experience matter so much when options appear in a customer account. Music drops briefly, tone steadies like the host leaning forward. Let's move into spreads, where investors buy and sell two options of the same type on the same underlying stock, but with different strike prices or expiration dates. A spread limits both risk and reward. It's a way to refine your market view without taking on open-ended exposure. There are two main categories: price spreads, also called vertical spreads, and time spreads, horizontal or calendar spreads. Here's how it works. A vertical call spread might look like this. Buy one ABC June 50 call at 6, sell one ABC June 60 call at 2. You've spent $6 and received $2, a net debit of $4. Since you paid to enter the position, this is a debit spread, and debit spreads are always entered by buyers. For call spreads, debit equals bullish because you want the spread to widen as prices rise. For put spreads, debit equals bearish because you want the spread to widen as prices fall. A credit spread is the opposite. You receive more in premiums than you pay. For call spreads, credit equals bearish because you want the spread to narrow as prices fall. For put spreads, credit equals bullish because you want the spread to narrow as prices rise. Music pauses for a beat. The next section comes in crisply. Matter of fact. Now let's make this real with an example. Sell one XYZ July 65 put at 7, buy one XYZ July 55 put at 2. You collected 7, paid 2. That's a net credit of 5. Because it's a credit put spread, you're bullish. Your maximum gain is the net premium received, $500. Your maximum loss is the difference between strike prices, 10 points, minus the net credit, 5 points, or $500. Notice something? The potential gain and loss are equal. That's how spreads create symmetry out of risk. Next come straddles, positions built from both a call and a put on the same stock with the same strike and same expiration. A long straddle, buying both a call and a put, bets on volatility. It doesn't matter which way the market moves, just that it moves enough to offset the total premium paid. A short straddle, selling both a call and a put, bets on stability. You profit only if the market stays calm, and both options expire worthless. Break-evens are easy to remember for straddles. For a long straddle, add the total premium to the strike for the upside break-even and subtract it for the downside break-even. For a short straddle, the math is the same, but you're hoping the stock price stays between those two break-even points. You'll also see combinations which look like straddles but use different strike prices or expirations. They're cheaper to enter and slightly less precise, a way to fine-tune expectations about direction and volatility. And before we move on, one last piece of the puzzle: hedging. Options can be used not only to speculate, but to protect. If you own stock, a long position, you can buy a put to protect against a decline. That's called a protective put. If you're short stock, a short position, you can buy a call to protect against a rise. That's a protective call. In both cases, you're paying a small premium for peace of mind, much like buying insurance. So here's your mental map. Calls buy, puts sell. Buyers hold rights, sellers hold obligations. Debit spreads equals pay, buy equals widen. Credit spreads equals receive, sell equals narrow. Straddles trade volatility. Hedges protect. Options at their core are about control over exposure, timing, and outcome. And for the Series 7, control comes from pattern recognition. Once you see the relationships between direction, debit or credit, and outcome, the math falls neatly into place. Next time, we'll stay in the world of derivatives, exploring advanced option applications, index and yield-based options, and how these contracts function in the broader market.